Hey guys, today I am here with Elva Wormley.
Yes.
She is a mortgage broker in the state of Maryland and the state of California. So one of the things I wanted to talk to you about today are ARM loans. I know
Yes.
for a long time we stopped hearing about them, right? And
That's
we were hearing
right.
a lot of bad things about them. So
Yeah.
can I pick your brain about it?
Absolutely.
So tell us what's an ARM loan and how does it work?
First off, ARM stands for Adjustable Rate Mortgage.
Okay.
And so an ARM loan is a loan that adjusts whenever the period, so there's 1 year ARMs, meaning the rate is fixed for 1 year.
Okay.
And then after that 1 year, the interest rate would adjust. A 3 year, 5 year, 7 year. The most common in the past have been the 7 year ARM.
Okay.
And one of the reasons is because with an ARM loan, they qualify you at a little bit higher than the start rate. Just to make
Okay.
sure that so when the rate goes up, you're not in shock.
That makes sense.
So if let's say the rate's 5% on a 7 year ARM, they would qualify you at, if the rate's at 5, they're going to qualify you at 7.
Oh, that makes sense.
So
Okay.
even though your payment for the first 5 years is going to be based on that lower rate, but at the end of 5 years, your rate could go up.
Okay.
And so they want to make sure that
And that's
you're
like a
prepared.
safety net for the buyer.
Exactly.
Okay.
And that really wasn't there a long time ago when the crash happened.
Okay.
And I think that's why some people have a negative attitude about
Yes.
ARMs.
So I'm glad they built that protection in
Yes.
there because if you only qualify for 5%, to have your mortgage jump to 7 because the market changes, that doesn't mean you qualify for 7. So it's great that they're checking now.
They're qualifying you at 7. Yes.
Okay.
Or-
So what are the pros and cons of an ARM loan?
The biggest pro is that you can get a lower mortgage payment
Okay.
for whatever the period is. If it's a 3 year or a 5 year or a 7 year or even a 10 year ARM, whatever the period is, you get that lower payment versus doing a 30 year fix.
Okay.
That's the pro. The con is that the rate can go up. And some ARMs go up every 6 months, some go up once a year. And then if you have a home equity line of credit, which is also an ARM, those go up whenever the Fed raises the rate. So
Okay.
it doesn't matter if it's 1 month or 2 months, your rate can go up.
Got it.
Whenever the Fed. But most people are doing, on first mortgages, they're doing either a 5 year or a 7 year ARM.
Got it.
Yeah.
Okay. So why are more people considering ARM loans right now?
I think the number one reason is everybody thinks rates are going to come down. We don't know when,
Yeah.
but in the next year or two, people are really feeling like the rates are going to come down. Now, we thought that last year, that they would be lower this year, and it didn't happen. But signs in the economy right now point to the fact that the Feds probably will lower rates.
Okay.
Keep in mind, though, that when they lower the rates, that's the Fed funds rate. That's not mortgage rates.
Okay.
So it takes time for mortgage rates to actually drop when the Fed's lower. Because sometimes people think, oh, the Fed's just lowered the rate in a quarter. My
Yeah.
rate's going to be lower.
Yeah,
Not
no.
necessarily.
No, but I'll be excited when the day comes,
Oh,
and I'm
so-
sure everyone else will. Buyers and sellers both will be excited. So, who's a good candidate for an ARM loan?
Well, I think anyone that wants to save money on their monthly mortgage payment. I don't think you have to be super wealthy or poor to get an ARM. I had a client years ago, all he ever got was ARMs.
Oh wow, okay.
And he saved money because ARM rates are always lower than 30-year fixed rates.
Gotcha.
And so he would get a 5-year ARM, and like in the 4th year, if rates were lower, he'd go ahead and refinance and get another 5-year ARM. And through his whole, and he paid off his mortgage faster that way.
Wow.
Because the payments, he would make extra payments because the payments were lower.
Okay.
So, and he was a wealthy guy. He didn't need to do it because he was trying to have lower monthly mortgage payments. He did it for the interest rate.
Gotcha.
Because there's a lot of people that have 7% right now on an FHA loan. Those are prime candidates to go down to a 5/1 ARM at 5.125.
Yes, absolutely.
And that could make a huge difference in their lifestyle to save that much money. Now, once you have, if you have a low interest rate 30-year fix, you wouldn't want to do it. So you just want to look at what is your current interest rate and what is the new rate going to be. And I'd say when you're going from a fixed rate to an ARM, I would say it should be about a 1% difference.
Okay.
But if normally I say only a 0.5%. When you're looking at refinancing, if you can improve your interest rate by a 0.5%, it's worth refinancing. But if you're going from a fixed rate to an ARM, you have to look at what the margin is and how high can it go.
Okay.
Then I wouldn't necessarily push someone out of a fixed rate into an ARM.
Got it.
Yeah. And whenever I have someone who has a tough time qualifying for their price range, now that
That's
the
what I
ARMs
was
are back,
thinking.
I have been I think right now is a great time to get an ARM. Because
Okay.
I do believe rates will come down. We don't know when.
Yeah.
I've been doing this since before you were born, Tova.
Okay.
And I have seen rates go up and down over the years. And so I know we're not going to be at this rate forever.
Yeah.
And I don't wish bad on the economy, but if the economy continues to worsen, that's only going to cause the interest rates to go down.
Got it.
So I think it's a good time to do an ARM. I would actually, if I was getting an FHA loan right now, I would do an ARM instead of a fixed.
Okay. Got it.
And the other thing that's nice is once you have an FHA loan, you can do a streamlined refinance.
Okay.
So, which is an easy refinance. We don't look at your income again when you refinance. All we look at is your credit score.
Okay.
So.
Wow, that's good to know.
Yeah, and the credit score, we only look at that to determine, because if your credit score is below 580, that's an issue. You can still get a loan, but that is an issue.
Yeah.
So, but yeah, I would get an ARM. If I was getting an FHA loan today, I would definitely get an ARM.
You hear that, guys? She was getting an FHA loan today. She would get an ARM.
Yes.
Probably not a bad idea with the prices still being really high.
Yes.
And a lot of people are finding that with the interest rates and the high prices, they're not able to afford the home that they want. So that's probably a great idea.
Yes.
Got you. Now, is there anyone who wouldn't be able to take advantage of an ARM loan?
Well, because FHA offers ARMs, if you qualify for an FHA loan, you'll be able to get an ARM.
Okay. Which is, can someone refinance out of an ARM loan? Can they do that at any time without penalty?
They can.
Okay.
Most government loans, that's FHA, VA, USDA, do not have prepayment penalties.
Okay.
And conventional loans don't either.
Okay.
Now, with FHA and VA, you do have to keep the loan for about 6 to 7 months.
Got it.
Depending. And so, I tell people, hey, if the rates should drop, then you're going to have to wait 6 months. But if the rates drop that much, it's still going to be available in 6 months.
Okay.
So, yeah.
All right. Got you. And then what should buyers look out for in the fine print when they're interested in an ARM loan?
I think knowing what your index is and what your margin is.
Okay, explain what that is.
So the index is what your interest rate will be based on.
Okay.
So, for example, the prime rate is an index.
Okay.
That Wall Street Journal prime rate, or it used to be something called LIBOR, but now it's SOFR. That is another arm. The CMT, which is a treasury index. So there's different indices. That's the index. That changes whenever the rates change for that index. And then there's the margin, which is fixed.
Okay.
The margin is added to the index to get your interest rate.
Got it.
So let's say your margin is 2% and you start out with the rate of, say, 7%. Your rate 7, and you got 7 because your index was, say, this is hypothetical, say your index was 4, and then your margin was, I said 2, didn't I? So let's say 6%. So let's say the rate, the index is 4, and then the margin is 2. So your rate's 6%. So you're set and you're fixed for 5 years. At the end of 5 years, let's say the index goes up to 5%, then you would add your margin 2% to that, and your rate would be 7.
Gotcha.
So it's the index plus the margin equals your interest rate.
Okay.
And so those two things you want to pay attention to. And then you also want to pay attention to your caps.
Okay.
That is how much your rate can go up on the first adjustment.
Okay.
So let's say at the end of 5 years, it may be capped at only 1%. And so that means that your rate can only go up 1% or only go down 1%.
Got it. Okay.
So that would
That's
be
super important.
yeah.
Okay.
And so some loans have a 1% cap and some have a 2% cap.
That's huge.
So you got to pay attention to
Yeah,
what that
that's
cap
something you guys want to pay attention to. Definitely the cap.
Mhm.
That will make a huge difference in your mortgage. Can you give them an example of like how big of a difference that cap can make? If you go from, let's say you purchase a $500,000 house, so a
Yes.
$500,000 house, and you go from a 5% interest rate to a 7% interest
Oh.
rate.
Oh,
What difference can that make
It-
in a monthly mortgage?
it could be a $400 difference.
That's huge.
That's huge.
Yeah.
That's why, interestingly enough, on the conventional loans, they qualify you at 2% above, and that's mostly because the cap is 2%.
Okay.
So they're qualifying you at 2% above the start rate,
Mhm.
so that way, if the rate does go up, you were qualified to that. Now, here's the caveat. People get qualified at 2% above, but they're only making payments. Let's say their payment's $300 less a month. They think, oh, I can buy a car, and my car payment is $290 a month. Then your payment goes up,
Yeah.
and now you when we qualified you didn't have that car.
Yeah.
So I tell people who get ARMs, keep that in mind.
Yes.
Know that this is only temporary, and at
Yes.
the end of that fixed period, your payment could go up to this amount.
Okay.
The nice thing is everything is disclosed. So when you sign the loan documents, it will tell you if rates go up, here's the maximum that your payment will go.
Okay.
But rates can go down, and that's the plus about ARMs too, is that if the rates come down, then your rate comes down.
Okay.
But ARMs do have a floor, meaning it won't go below a certain rate. And
Gotcha.
most won't go below the index.
Okay.
Whatever that index is. And the other thing to keep in mind is, so you got that first adjustment, and then there is, after that first adjustment, how much will it adjust every year thereafter or every 6 months thereafter?
Okay.
That could be 2% or 1%.
Mhm.
And then there's the lifetime adjustment. How high can it go over the life of the loan? And sometimes that could be a 5% adjustment.
Gotcha. So pay attention to the fine print.
Yeah.
Pay attention to the fine print. Ask questions. Well, I thank you so much, Elva, for answering all my questions. Guys, if you have any questions for Elva, I'll be sure to leave her contact information below. I'll tag her Instagram and leave her number and email address. Thank you.
Thank you.
Bye.